Gold has been around for 3,000 years. S&P's been around since 1950s. The Federal Reserve has been around for a century. So they're baby markets compared to gold, okay? And I think what gold sees coming is what we see technically, and that is a lot of markets where a lot of assets have been committed and hopes based upon and inflated by the Fed over the past dozen years plus through cheap interest rates and money flow. When those break, it's going to be painful. So anyway, gold sees this, and it knows ultimately, no matter what the Fed said for the last year or so, that's going to go by the way. And the central banks are going to go back to liquidity, easier rates, et cetera, meaning what they do best, which means inflationary policies. And that's why gold is pushing at all-time highs.
March 2024 witnessed an impressive 8.5% surge in gold prices, marking its strongest monthly performance since July 2020. During that period, gold experienced a remarkable 10.8% increase, buoyed by significant monetary and fiscal stimulus measures implemented during the COVID-19 pandemic. Momentum and technical analyst Michael Oliver forecasts market turmoil, particularly in stocks and real estate, akin to the 2008 and 2009 crisis due to central bank policies. With expectations of central banks returning to inflationary policies, Oliver anticipates gold to soar to record highs. His analysis relies on momentum measurements, indicating an upcoming shift in favor of silver and even mining stocks relative to gold. Gold has generally outpaced performance in silver over the last few years, but the tide may soon turn in favor of silver. Forecasts pointing to a fourth straight yearly deficit in global supplies and a rise in demand to its second highest level on record raise the potential for silver prices to rally and even roughly double before the end of 2024. With T-bonds lagging slightly behind gold, Oliver advises investors to monitor both markets closely. He further envisions T-bonds gaining traction as popular alternatives to stocks over the next few quarters. Indeed, the decline in U.S. yields indicates a shift in investor sentiment toward U.S. Treasury bonds, potentially posing a challenge for non-yielding assets like gold. The 2-year and 10-year yields on U.S. Treasury bonds held steady at 4.60% and 4.21% respectively. Investors may find bonds' relative safety and stability more attractive than gold. Among safe haven investments, gold competes with bonds and bank deposits. For instance, a bond offering a fixed 5% annual return would be appealing when inflation is at 2%. However, if inflation rises to 8%, the attractiveness of the bond diminishes. Now, we present the clips of Michael Oliver's insights from his recent interview with Liberty and Finance. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
Gold is behaving, it's the leader of the pack, the mama market. Silver and the miners still lag, but I think that's about to change. And I say that technically. In other words, we measure the relationship between silver and gold in terms of the momentum of the spread and also the miners versus gold. And we all know, everybody knows who's in that market, that the miners have gone down for the last several years. GDX, for example, had a peak trade back in 2020 at $45. Right now it's trading at 31, okay? And that's a rally, okay? So while gold's well above the highs of the last few years, the miners are still well below. And I think that's about to change, especially if we close the month out near today's highs or close next month out at these levels. We've got some annual momentum measurements of these markets, meaning long-term trend metrics. They're about to engage in a way that says, okay, sleepy time is over. And I think that will wake up silver and the miners relative to gold. Gold has been around for 3,000 years. Okay, S&P's been around since 1950s. The Federal Reserve has been around for a century. So they're baby markets compared to gold, okay? And I think what gold sees coming is what we see technically, and that is a lot of markets where a lot of assets have been committed and hopes based upon and inflated by the Fed over the past dozen years plus through cheap interest rates and money flow. When those break, it's going to be painful, and painful in areas of the economy that the Fed cannot put up with. In other words, cannot allow. They like to break commodities, they say, although commodities, we'll get to that in a minute. What they're going to break and our assessment is they're going to break the stock market and some other related markets. Real estate's already in trouble. and so forth. But when it breaks, remember 2008 and 9, remember the in the street pain that people felt, even if they weren't in the stock market. They got laid off, et cetera, all kinds of hurt and doubt. And when that happens, panic sets in. And I think the stock market is in a teasing last mode here in terms of its upside probing. And when it fails, it's going to surprise people and that's when you'll start to see those data points that everybody likes to point to suddenly change. They won't change ahead of the stock market. They'll change after the stock market. That's usually the way it occurs. And that's when the Fed, the other central banks will have to revert back to what they do best. And they've already said, we're going to cut rates 3 times this year. Okay, just a matter of when. Why did they say that? What concerns them? One thing that concerned them is their bond market crashed last fall. That concerned them greatly. So anyway, gold sees this, and it knows ultimately, no matter what the Fed said for the last year or so, that's going to go by the way. And the central banks are going to go back to liquidity, easier rates, et cetera, meaning what they do best, which means inflationary policies. And that's why gold is pushing at all-time highs. And also the T-bond market, which has been over time, this is a true statement about its relation to gold. There's times when T-bonds move with gold, which when their price goes up, yield goes down, gold's going up. There's times when the opposite's the case. So it's not always the case that it's totally in sync with gold, but right now it's slightly lagged to gold, actually. We're watching both long-term, the 30-year T-bond futures and TLT, the ETF of long-term U.S. government bonds. And they're both very ripe for upside breakouts that will continue. The surge that we had from that October low last year was vertical. We expected the crash and we expected the vertical low. But since December, they've backed off modestly, not terrifically, but they've not given up the gains from that October low. That shocked the Fed, that collapse. But the pullback we've seen in T-bonds lately, meaning higher yields, we think is about to be arrested, and they're about to go through the price levels we saw back in December, meaning rates go down again. I think that will be also inverse to the S&P 500. So when you're watching the stock market, expect gold to behave opposite, but also watch the T-bonds because they could become, for a while anyway, let's call it for several quarters, a popular alternative to the stock market.
March 2024 has been a golden month for gold mining stocks, marking their best performance in a year. The robust surge in gold prices has lifted the values of gold mining companies, with the VanEck Gold Miners ETF climbing about 20% for the month, marking its best monthly performance since November 2020. With expectations of stock market uncertainty looming, Oliver foresees a notable shift in asset allocation towards alternative sectors. He predicts that gold miners could particularly benefit from this repositioning, emerging as a favored option among investors. Furthermore, Oliver states that silver and mining stocks are ready for a significant rally to reach their 2020 highs, even outpacing gold's performance in the coming months. Let's get back to the interview.
Gold will already be ahead of the game, okay? And we're at certain levels right now on silver and the miners as well that will cause them to engage in a more dramatic manner. I mean, literally, the price is up to a level that will break annual momentum through a trigger level, okay? And at that point, I think they'll suddenly get a jolt and join gold. But already we've seen some large asset managers, and I don't mean gold bugs, but just general large hedge fund and other fund managers shift into the miners, which I find very interesting. Stanley Druckenmiller, I think it was like a month ago, announced he was dumping, maybe it was less than a month ago, dumping some big large tech stocks and going into Newmont and Barrick Gold, two of the big blue chip gold miners. And you got to realize this sector, and there's been some other hedge fund managers that have done the same. So they're starting to move some of their capital over into a sector that they view as both vastly undervalued and also ultimately linked to gold. And they, I think, see what we see as the potential dynamics here. And rather than wait for the event, they're starting to move some assets over. But the fact is, though, the gold and silver mining sector is a tiny little sector. It won't take much capital to boost it. I use this idea of the wet bar of soap being grabbed by people, it squirts up. And that's basically what we've got with the miners right now, I think, is a vastly oversold market situation, undervalued by any metrics, undervalued in relation to gold, undervalued in relation to the historical relationship to the S&P, et cetera. And when the money starts to get doubtful to the stock market, remember, some of these fund managers that are in the stock market doubt it, but they've got to be in it because they're competing with peers who are in it. And if they're not in it and catching the profits, then, they lose client base. So they're in it, but they're doubters. And it won't take much provoking on the part of a wobble in the stock market to cause them to move more and more assets into categories they deem to be alternatives. And I think the gold miners are one of those prime categories. My own personal assessment is that I'm going to emphasize silver positions, using SLV, for example, as an ETF, or the Sprott Silver Trust, or the miners, such ETFs as GDX. Also, there's the silver mining ETF, SIL, which only contains silver miners. They both look technically like they're about to engage in a way that will get them back to their highs, the highs of 2020. Remember, for GDX, we're trading 31 plus right now. That high was 45. Well, that's a 50% move just to get there. And I think that could happen fairly quickly if certain numbers are engaged, and we have them in our report, certain trigger levels are hit. And at that point, just getting back to its 2020 price high, even though gold is well above that high, will be a more percent move for the miners than will be what gold does in the coming, let's say, 6 months. So I think there's a catch up there. And I personally, what I'm doing is I'm focused more on the miners. Yes, gold is the mama. You got to watch the mama, but the mama's looking good. And I would at this point think that the laggards, silver, and the miners are about to snap and catch up. There's certain trigger levels that will pound the table over to our subscribers when we get to them. And we're toying with them right now.
In the past few years, gold investment has soared, hitting an 11-year high last September and breaking numerous price records. As March ends, with upcoming economic reports and a Federal Reserve meeting in April, many may wonder if now is still a good time to invest in gold. Concurrently, the gold markets will continue to see a lot of upward momentum, as we have seen a lot of concern worldwide. Does the current environment present a favorable opportunity to diversify portfolios with the precious metal? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.